Tonight we are going to talk about something that should be on the radar of every single American, whether you follow geopolitics closely or whether you have never heard of this place before in your life. We are talking about the Strait of Hormuz, a narrow strip of water on the other side of the world that has more power over your daily life than most people in this country realize. And we are going to answer one very specific, very urgent question. What happens if Iran closes it? Now, before I get into the consequences, and trust me, the consequences are staggering, let me make sure everyone understands exactly what we are talking about. Because if you are going to understand why this matters, you need to understand the geography first. The Strait of Hormuz is a narrow waterway that sits between Iran on one side and Oman and the United Arab Emirates on the other. It connects the Persian Gulf to the Gulf of Oman, and from there to the open waters of the Arabian Sea and the Indian Ocean. At its narrowest point, this strait is only 21 miles wide. The shipping lanes that tankers actually use are even narrower, roughly 2 miles wide in each direction, with a 2-mile buffer zone in between. That is it. That is all the room the global economy has to work with. And through that tiny corridor flows approximately 20 to 21 million barrels of oil every single day. Let me put that number in perspective for you. The world consumes roughly 100 million barrels of oil per day. That means approximately 20%, 1/5, of the entire world's oil supply passes through a choke point that you could practically see across on a clear day. Add in liquefied natural gas shipments from Qatar, which is the world's largest LNG exporter, and you are looking at a volume of energy trade that is absolutely irreplaceable in the short term. There is no alternative route. There is no backup plan that can handle that volume. There are some pipelines that bypass the strait. Saudi Arabia has the East-West pipeline. The UAE has the Habshan-Fujairah pipeline. But combined, these alternatives can handle maybe 6 or 7 million barrels per day at maximum capacity. That still leaves a shortfall of 13 to 14 million barrels per day with no way to get them to market. So now you understand the stakes. Now let us talk about what actually happens if Iran follows through on its long-standing threat to shut this waterway down. Let us start with oil prices because that is the most immediate and most dramatic impact. If the Strait of Hormuz is closed, whether through naval blockade, through mining the waterway, through military force, or through a combination of all three, you would see the single largest disruption to global oil supply in modern history. Nothing in the past comes close. Not the 1973 Arab oil embargo, not the Iranian Revolution in 1979, not the Iraqi invasion of Kuwait in 1990, not the Libyan Civil War, nothing. Oil prices would spike immediately and violently. We are not talking about a $10 or $15 increase. We are talking about oil potentially doubling or even tripling in price within days. Analysts at major investment banks and energy research firms have modeled this scenario extensively. The consensus range for oil prices in a full closure scenario is somewhere between $150 and $300 per barrel, depending on how long the closure lasts and how the rest of the world responds. At $150 per barrel, you are looking at gasoline prices in the United States hitting $6 to $7 a gallon almost overnight. At $200 per barrel, you are looking at $8 to $9 a gallon, and at $300 per barrel, which is admittedly a worst-case scenario but not an impossible one, you are looking at gas prices that are simply unprecedented in American history. Double digits, $10, $11, $12 a gallon. Prices that would fundamentally alter how Americans live, work, and travel. And remember, this is not just about the price at the pump. This is about everything that moves. In the United States, approximately 70% of all freight is moved by truck. Trucks run on diesel. When diesel prices double or triple, the cost of moving every single product in this country, every box of cereal, every gallon of milk, every piece of furniture, every package from Amazon, goes up. And those costs get passed directly to you, the consumer. This brings us to inflation, and this is where the situation goes from painful to potentially catastrophic. The United States has spent the better part of the last 3 years fighting the worst inflation crisis in 4 decades. The Federal Reserve has raised interest rates aggressively. American families have tightened their belts. Businesses have adjusted. And slowly, painfully, inflation has been coming down toward the Fed's 2% target. A closure of the Strait of Hormuz would blow all of that progress to pieces. We would see an immediate supply-side inflationary shock that would dwarf anything we experienced during the post-pandemic price surge. Energy prices feed into every single sector of the economy. Transportation costs, manufacturing costs, heating and cooling costs, agricultural costs, chemical production costs, all of them are tied to the price of oil and natural gas. When those input costs spike, the prices of finished goods spike with them. Food prices would be hit especially hard. Modern agriculture is extraordinarily energy intensive. Fertilizers are made from natural gas. Farm equipment runs on diesel. Food is transported by truck, by rail, and by ship, all of which consume petroleum products. A sustained spike in energy prices could push grocery bills up by 30, 40, even 50%. For American families who are already stretched thin, that is not an inconvenience. That is a crisis. And here's the part that makes this particularly dangerous from a policy standpoint. The Federal Reserve cannot fix this kind of inflation with interest rate hikes. Supply-side inflation is caused by a reduction in the availability of critical inputs, in this case, energy. Raising interest rates does not produce more oil. It does not reopen a shipping lane. It does not bring tankers through a mined waterway. All raising interest rates does in this scenario is slow down economic activity, reduce consumer spending, and increase the risk of recession, while prices continue to climb. That is the nightmare scenario. It is called stagflation. High inflation combined with economic stagnation. We lived through it in the 1970s, and it was one of the most economically painful periods in American history. Unemployment rose. Real wages fell. The stock market stagnated for nearly a decade, and the root cause was the same: a disruption to Middle Eastern oil supply. Let us talk about what happens in the financial markets. The moment the Strait of Hormuz is closed, you would see panic selling across global equity markets, and I do not use the word panic lightly. The S&P 500 could easily drop 10 to 15% in the first week. The Nasdaq, which is heavily weighted toward growth and technology stocks, could fall even further because tech companies are valued based on future earnings growth, and a severe energy crisis and potential recession dramatically reduce expectations for future growth. Circuit breakers would likely be triggered on major exchanges. For those who are not familiar, circuit breakers are automatic trading halts that kick in when markets fall too quickly. They are designed to prevent total market meltdowns. The fact that we would likely need them tells you something about the severity of the situation. But not every sector would lose. Energy stocks would explode to the upside. ExxonMobil, Chevron, ConocoPhillips, Pioneer Natural Resources, Devon Energy. These companies would see their revenues and profits surge as oil prices skyrocket. Defense and aerospace stocks would also rally sharply. Lockheed Martin, Raytheon Technologies, Northrop Grumman, General Dynamics, L3 Harris. A major military conflict in the Persian Gulf means massive defense spending, and Wall Street would price that in immediately. Gold would surge. Gold is the classic safe haven asset in times of geopolitical crisis. You would likely see gold prices blow past previous all-time highs and potentially reach $3,000, $3,500, even $4,000 per ounce, depending on the severity and duration of the crisis. The bond market would be chaotic. Initially, you would see a massive flight to safety into U.S. Treasury bonds, pushing yields down sharply. But that flight to safety would be in direct conflict with the inflationary implications of the crisis, which would normally push yields up. The result would be extreme volatility in the bond market, the kind of volatility that can cause serious problems for banks, pension funds, insurance companies, and other institutional investors that hold large bond portfolios. The US dollar would strengthen in the short term because of its status as the world's reserve currency. In times of crisis, global investors buy dollars. But a stronger dollar has its own complications. It makes American exports more expensive, hurting US manufacturers and farmers. And it puts enormous pressure on emerging market economies that have borrowed in dollars, potentially triggering debt crises in countries like Turkey, Argentina, Egypt, Pakistan, and others. Those crises, in turn, can create secondary shockwaves that ripple back through the global financial system. Now let us talk about something that most news coverage overlooks: the impact on countries that are far more dependent on Persian Gulf oil than the United States. China imports roughly 70% of its oil, and a huge portion of that comes through the Strait of Hormuz. Japan imports virtually all of its oil, and a massive share transits the strait. South Korea, India, and most of Southeast Asia are in similar positions. These are not small economies. China is the second largest economy in the world. Japan is the third. India is the fifth. A closure of the Strait of Hormuz would be an existential economic threat to these countries. Why does that matter to you as an American? Because we live in a globally interconnected economy. If China's economy crashes, the demand for American goods and services drops. American companies that do business in Asia see their revenues fall. The global supply chain, which is still heavily dependent on Asian manufacturing, gets disrupted again. Semiconductors, electronics, auto parts, pharmaceuticals, consumer goods, all of it gets affected. And here is the geopolitical wildcard. If China, Japan, India, and other major economies are facing an energy crisis because of a closure of the Strait of Hormuz, what do? Do they sit on the sidelines and wait for the United States and its allies to resolve the situation? Or do they take independent action to secure their own energy supplies? The potential for miscalculation, for escalation, for the conflict to widen beyond the Persian Gulf is very real. And a wider conflict means even more economic disruption, even more uncertainty, and even more damage to global markets. Let us talk about the Strategic Petroleum Reserve. This is the emergency oil stockpile that the United States maintains for exactly this kind of situation. As of now, the SPR holds roughly 350 to 400 million barrels of crude oil. That sounds like a lot, and it is. But the United States consumes roughly 20 million barrels of oil per day. So even if we were to draw down the SPR at maximum capacity, which is about 4.5 million barrels per day, it would only last a few months, and it would only partially offset the global shortfall. The SPR is a bridge, not a solution. It buys time. It does not solve the underlying problem. Other countries have their own strategic reserves. The International Energy Agency coordinates emergency stockpile releases among its member nations, but collectively, these reserves are designed to handle short-term disruptions of a few weeks to a few months. A prolonged closure of the Strait of Hormuz, lasting months or longer, would overwhelm these reserves entirely. Now, could Iran actually do it? Could they actually close the Strait of Hormuz? This is a question that military analysts have debated for decades. The honest answer is that Iran probably cannot permanently close the strait against a determined U.S. military response. The United States Navy's Fifth Fleet is based in Bahrain, right on the Persian Gulf. We have aircraft carriers, destroyers, submarines, minesweepers, and surveillance aircraft in the region. The U.S. military has the capability to reopen the strait by force. But, and this is a critical but, Iran does not need to permanently close the strait to cause catastrophic economic damage. Iran has a large arsenal of anti-ship missiles, many of them mobile and difficult to locate. Iran has a substantial fleet of fast attack boats that can swarm commercial tankers. Iran has the capability to lay naval mines, and mine clearance is one of the most difficult and time-consuming military operations that exists. Even if the U.S. military could clear the strait of mines and neutralize Iranian missile batteries within a few weeks, those few weeks would be enough to send oil prices into the stratosphere and create an economic shock that would take months, if not years, to fully recover from. And there is the insurance factor. Even after the strait is militarily reopened, commercial shipping companies and their insurers may be unwilling to send tankers through the waterway if there is any remaining risk of attack. War risk insurance premiums would be astronomical. Some shipping companies might refuse to transit the strait entirely, and even a partial reduction in tanker traffic through the strait would keep oil prices elevated for an extended period. So what is the bottom line? What is the takeaway for you, the American citizen, the American consumer, the American investor? The bottom line is this. The Strait of Hormuz is the single most important choke point in the global economy. Its closure, even temporarily, would trigger the most severe energy crisis in modern history. Oil prices would spike to unprecedented levels. Gasoline prices would soar. Inflation would surge. Financial markets would plunge. The Federal Reserve would be trapped between fighting inflation and preventing a recession. Consumer confidence would collapse, and the economic pain would be felt by every single American household, from the wealthiest to the most vulnerable. This is not alarmism. This is not fear-mongering. This is the reality of a globally connected economy that remains fundamentally dependent on fossil fuels flowing through a 21-mile-wide waterway, half a world away. Does this mean you should panic? No, absolutely not. But it does mean you should be informed. It means you should understand the risks. It means you should think carefully about your financial decisions, your investments, your savings, your exposure to energy costs. It means you should have contingency plans. And frankly, it means that as a nation, we need to have an honest conversation about energy security, about diversification of energy sources, about the strategic importance of domestic production, about the role of alternative energy in reducing our vulnerability to exactly this kind of geopolitical shock. Because the Strait of Hormuz has been a potential flashpoint for decades. And if there is one thing that history teaches us, it is that potential flashpoints have a way of becoming actual flashpoints when you least expect them. America has faced economic crises before. We have weathered oil shocks before. We have come through wars and recessions and market crashes. And every single time, this country has come out the other side stronger. But we come out stronger because we prepare, because we adapt, and because we refuse to be caught off guard. So stay informed, stay prepared, understand the risks, and understand that what happens in a narrow waterway between Iran and Oman can and will affect the price you pay for a gallon of gas, the value of your retirement account, and the overall health of the American economy. That is the reality, and you deserve to hear it straight. I will see you right back here next time. Stay sharp, America.